Hi, this is Damon King, Certified Financial Planner and Investment Advisor with ChappelWood Financial Services with your 2018 market commentary for July, thanks to our partners JP Morgan and City National Rockdale. Markets have rebounded from their March lows, and stocks have shown a lot of resilience even in the face of more volatility and uncertainty, pushing the S&P 500 into positive territory year to date. On one hand, we've got continued growth in corporate profits, we've got low interest rates and low inflation. That should make people happy. But on the other hand, we still have tensions around tariffs and a potential trade war with China, rising stock prices, uncertainty in the political environment, and fears that inflation and interest rates are going to grow faster than expected. These are all conspiring to erode investor confidence. So let's take a look at both sides of this little battle. Economic fundamentals remain very strong, and considering that this current expansion is going on 10 years old now, that's saying something. From all the data and research that we receive from our wealth management partners, we believe that over at least the next 12 months, the U.S. economy is at a very low risk for recession. That said, we do still believe the Federal Reserve will raise interest rates, albeit at a gradual level. On the other side, we have tariffs, and concerns over a trade war with China aren't likely going anywhere anytime soon. This is likely going to weigh on investors, but we believe that the fallout will be contained, at least for right now. Growth cycles end when interest rates rise, which depress stock prices and investor confidence. However, the increase in volatility that we saw earlier in the year wasn't triggered by a decrease in global economic slowdown. In fact, what triggered it was an unexpected increase in U.S. wages, and that made investors believe that inflation was about to go out of control, which is what caused the correction we saw. Volatility and sideways movement are to be expected in this type of an environment. This 2 steps forward, 1 step back mentality means that investors are taking a couple of quarters to digest what's happening and to determine if earnings growth will continue to go up even in the face of rising interest rates. Now, you've probably heard the phrase follow the money. Well, that's exactly what markets do. They follow earnings growth. And earnings growth isn't about only the lower tax rates. This actually goes back to mid-2016 when we saw global economic conditions strengthen. In closing, we recognize that volatility and risk have risen. However, we remain confident that there's enough support and strong earnings in the economy to keep at least a portion of your money invested in the market. Keep in mind that the volatility we are seeing makes for great headlines, but it's actually been pretty low relative to historical trends. We believe there is still positive momentum in this business cycle. Of course, if volatility is on top of your mind and you're worried about it, our recommendation is to consider pulling some of your earnings from 2017 off the table, protecting it. The best strategy is to spread the risk around, and the best time to do that is when the sun is shining and the seas are calm. This is Damon King with ChappelWood Financial. Thanks so much for watching.